To jest podcast System Trader, odcinek 43. A dziś Robert Carver o profesjonalnym podejściu do inwestowania, czyli rynki finansowe według quanta.
Interesujesz się inwestowaniem na rynkach kapitałowych? Szukasz swojego sposobu na oszczędzanie i pomnażanie pieniędzy? Zastanawiasz się, jak postawić swoje pierwsze kroki na giełdzie? Ponadto fakty, mity, wywiady i ciekawostki ze świata finansów. To i wiele więcej usłyszysz w podcaście System Trader. Zaprasza Jacek Lempart.
Robert Carver przez lata pracował w londyńskim City jako quant trader w dużym funduszu hedge o nazwie HAL, zarządzającym obecnie aktywami o wartości ponad 30 miliardów dolarów. Współzałożycielem tego funduszu był David Harding, człowiek ikona w świecie inwestycyjnym, a przy okazji miliarder i stały bywalec najbogatszych osób w Wielkiej Brytanii. Robert bez owijania w bawełnę opowiada, jak wygląda inwestowanie z wykorzystaniem algorytmów na rynkach i dlaczego większość ludzi nie będzie w stanie inwestować z powodzeniem, podejmując decyzje w sposób uznaniowy. Tak, bez algorytmów. Przytacza fantastyczną historię, jak pewnego dnia we wrześniu 2008, w samym środku największego kryzysu finansowego od dekad, wszyscy w londyńskim biurze byli spanikowani i blisko o włos od podjęcia decyzji opuszczenia rynku, póki istniała jeszcze taka możliwość. Cały handel funduszu był zautomatyzowany, strategie działały zgodnie z założeniami, a mimo wszystko był strach, czy nie zawali się światowy system ekonomiczny, a wraz z nim nie wyparują wszystkie pieniądze. Totalny brak wiary w jutro. I pytanie, czy relatywnie prosta strategia może podjąć lepsze decyzje od ludzi? Podczas narady w sali konferencyjnej, gdy ludzie w stresie zaczęli dzielić włos na czworo, mechaniczne strategie funduszu pierwszy raz w historii firmy zarobiły okrągły miliard dolarów. Tak, miliard zysku w jeden dzień. Robert rozprawia się w tym wywiadzie z wieloma mitami, uproszczeniami, przeinaczeniami i przesądami, które w pewnym sensie prześladują świat inwestorów indywidualnych. Funkcjonują one jako chwytliwe medialnie uproszczenia, nie mając wiele wspólnego z rzeczywistością. Jest to mimo wszystko materiał z pozytywnym przesłaniem. Każdy z nas w domowych warunkach może realizować proste strategie, które działają wręcz od stuleci. Nie trzeba odkrywać świata na nowo, ale należy wiedzieć, co się robi, w szczególności kontrolując ryzyko. To tu jest zakopane złoto. Zapraszam serdecznie do wysłuchania wywiadu z Robertem Carverem oraz do odwiedzenia strony internetowej tego odcinka pod adresem systemtrader.pl/043. Niestety, wywiad dostępny jest tylko w języku angielskim. W przeciągu kilku tygodni pojawi się jego transkrypcja. Mam też prośbę, jeśli uznasz, że prezentowane przeze mnie treści mają dla Ciebie wartość, podziel się tym z innymi i wystaw recenzję na przykład w Apple Podcasts. To pozwoli dotrzeć mi do szerszej publiczności, a kto wie, w przyszłości może i sfinansować tłumaczenie takich materiałów jak ten. Z góry bardzo dziękuję. Zapraszam serdecznie do wywiadu.
Hello Rob and welcome to the show. Could you please introduce yourself and tell a bit about your trading career and trading experience?
Okay, so my first trade was about 20 years ago, and that was the time of sort of big technology boom in internet stocks that was sweeping the world. So I kind of dabbled in that. I didn't have very much money at the time, so I would just buy shares, and they seemed to go up, and then I would sell them. So not a particularly sophisticated strategy. And then in 2002, I actually started working for an investment bank as a fixed income options trader. I did that for about 18 months, so professionally trading. And then I took a couple of years off working in the industry, but I was still trading my own money and kind of gradually getting to grips with that. And then after that, I got a job with AHL, which was a large systematic hedge fund. And that was when I began sort of trading, large amounts of money. So it was a multi-billion-dollar fund. And towards the end, I was actually managing the entire fixed income portfolio that was about $5 or $6 billion. So, very large amounts of capital. I did that till 2013. So just over 6 years ago now. And then I actually left the industry and decided to just kind of take it easy. So I've still been trading my own money though, and I've got a fully systematic trading strategy that trades futures, and I also have other systematic strategies which aren't automated, trading ETFs and stocks. So I've done various things over the last couple of decades, but I'm now very firmly in the systematic camp of trading.
All right, that's very impressive. Thank you for that, Rob. Let me diverge for a short while from the main theme of this podcast episode, which is systematic trading and investing. I live now in Belgium for several years and was following the Brexit talks for some time. And yesterday there were elections in the UK. So I'd like to take the occasion and to ask you for an opinion you maybe have here, because after all, you're British, so your perspective is probably different than mine. Would you agree that democracy as such, or democratic world, is in crisis, so to speak? I'm not talking only about the UK, but let's say in general.
Yeah, I mean, there used to be this joke that politicians were liars, and the ones who told the most convincing lies would win the elections. And I guess that's always been true to a degree. But I think in the last few years, and I don't know whether you can blame it on social media or on the more polarized kind of mainstream media. But, the election of Trump and the election we had yesterday, it was a lot of people were telling some pretty big lies. And if you were looking in the right places, you could find people who were saying, you know what, we've fact-checked this and this isn't true. But I don't think, though, those fact-checking messages were reaching the vast majority of people because they were just reading the newspapers that suited their opinion or reading the Facebook posts or the Twitter posts that suited their opinion. So they were only seeing one side of the argument. They weren't seeing this kind of neutral, more unbiased opinion that we used to get from the media. So America, I guess, is worse because they do have very polarized TV networks there. So have Fox News, which is a kind of very pro-Trump, and then other networks that are perhaps less biased. In the UK, at least, the TV media is relatively unbiased, but I guess people just aren't watching TV news so much. So, they're living in their little echo chambers, and it means that as a politician, you can get away with telling much bigger and many more lies, and people will believe it and vote for you. I mean, it's a pretty cynical and depressing view, but, when I woke up this morning and saw the result, I was pretty depressed, and I am still pretty depressed, to be honest, about the state of this country and politics generally. Absolutely.
And do you think that the UK will leave eventually European Union next year?
I have to say that my kind of probability has probably gone up to about 90%. I mean, we are going to leave the European Union at the end of January into this transition period. The question then is what happens next. I'm still hoping that there'll be some kind of very long and protracted negotiations at the end of which we may just go back into the EU or end up with a deal which is, as good, well, not as good as, but close enough to being in the EU that it doesn't do too much damage to the country. But I think the chances of that now are probably quite low. As I said, maybe 10%, and there's a 90% chance that we're going to have a Brexit that's going to be, either bad or really bad.
Right. I think that the political reality is becoming very far from, let's say, economic reality, which is hard to probably understand by the majority of people, and they just vote what they hear, maybe. And as you said, who's the best liar is winning. Okay, so thanks for your opinion on that. Let's return to our main theme of this show and talk about the trading and investing. So you said that you're now managing your portfolio using what you basically learned also in the hedge fund, right? So what you learned at HAL, for example, are you using this knowledge to some extent, that the experience to your own portfolio?
Yes, I mean the sort of there's three components to my portfolio essentially. So the part that you describe as trading is trading futures, and the approach I'm using there is very, very similar to the approach that AHL was using. And the return streams have probably got a correlation of over 90%. So that's a very similar system. And then the rest of my portfolio is still run systematically, but it's investing rather than trading. So there's much longer holding periods. And there, my approach is, I guess, still based around the same principles of doing things systematically and thinking very carefully about things like, what sort of returns and risk are out there, and how diversification can help you, and how using certain kinds of keys can hopefully improve your return. So I the whole piece is run very much along the same principles, but obviously the details are different depending on whether I'm trading futures, which I might be holding for a few weeks, versus some ETFs, which I expect to hold for several years.
Right. Do you think that working for a hedge fund is a good way to learn about investing, about trading?
It is. It's a great way to learn. I hesitate to recommend it because obviously it's quite hard to get a job in a hedge fund. And I think a lot of people that you see on the internet who are into trading, they're into trading, their own accounts, and maybe half of them want to carry on trading their own accounts and make that into an income stream. And the other half think that by trading their own accounts, it'll get them to get a job with a hedge fund. And so I've kind of gone in the opposite direction. I used to work for a hedge fund, and now I trade my own account. So I do almost certainly have more knowledge and experience than the average trader. It doesn't necessarily mean I'm going to make many times more profit, because there's a lot of luck involved. But I'd say that I've learned a lot, and principally I've learned to avoid certain key mistakes that I guess we'll probably talk about at some point in this interview. So it's less about the fact that I've learned some dark magic secret at the heart of hedge funds, which I can now exploit with my own capital. It's more that I've learned through making mistakes, and also from learning from other really smart, experienced people, what to avoid and the basic principles you should follow.
Right. I've just found out, by the way, that also David Harding was one of the co-founder, if I'm correct, of HIL, which is a kind of iconic person in the investment world. But do you think that an average retail investor, retail trader may learn your skills at home?
Oh, absolutely. I mean, they just need to read my books. I've published 3 books, or read my blog. And, if they did that, and, certainly in terms of, for example, automating the system, they would also need to have some skills in programming. But it's actually possible to do the vast majority of what I do just using a spreadsheet. But, I'd say that someone could read my books, read my blog, and be kind of 99% of the way towards doing what I'm doing. I mean, there are still a few things that I don't disclose, but in terms of the current system I'm trading. But the vast majority of it is public information. I guess what they couldn't necessarily do is then develop a trading system from scratch, using some perhaps new indicators. Because although I've tried to pass along, the sort of methodology and techniques I think you should follow in doing that, it is still, I think, a skill that requires a fair bit of experience and learning, and maybe not everybody could do that. But in principle, yeah, it's possible.
And you said that you don't disclose some details. Is it because you're afraid that this edge would just disappear if more people would start using it, or there are some different reasons for that?
No, it's because I signed a very lengthy legal document when I joined AHL saying that I wouldn't reveal anything that wasn't public information, and right. I'm still, beholden to that. So, it's because I don't want to get sued, basically.
Sure, of course. You mentioned about your books, and you're the author of 3 wonderful books. The first one is Systematic Trading, a unique new method for designing trading and investing systems. Another one, Smart Portfolios, a practical guide to building and maintaining intelligent investment portfolios. And the latest one, which was just released, Leverage Trading, a professional approach to trading FX, stocks on margin, CFDs, spread bets, and futures for all traders. Could you please tell us a bit about these books and who's the target audience?
Sure. So I guess we can split them into 2 categories. So there's 2 books on trading, so systematic trading and leverage trading, and 2 books on and a book on investing, which is Smart Portfolios. And you know what, the lines between trading and investing are a bit blurred anyway. And in fact, in systematic trading, I actually talk about essentially what many people would think of as investing in one of the chapters, but never mind. So systematic trading is aimed at people with some experience in the field. So if you've got literally no idea how to trade, you probably struggle to read it, and it does require a little bit of a kind of mathematical understanding as well. Although you don't need to know anything particularly complicated. In fact, someone reviewed the book and said there are not enough equations in this book. So it just goes to show you that it's not a very mathematical book. And it's aimed at people who have also a reasonable amount of trading capital. So, in the book I discussed some examples, and one of the examples is for someone who has $100,000, I think, off the top of my head. And one of the examples is for someone who has 10 million euros. And then there is an example that sits between those. So, it's not designed for the guy who's got, a couple of $1,000s and doesn't really know how to trade. So leverage trading is very much designed for that person. So it's designed for somebody who doesn't have much capital and also doesn't have as much experience. So I do go into a lot more detail about how trading of different products works. And the reason it's called, leverage trading rather than systematic trading for beginners, which, is another title, or an idiot's guide to systematic trading, I suppose you could say, is that it's not just about systematic trading. It's about specifically trading leverage products, so that, products where you can take leverage on. And the reason I decided to focus it on that was because, that is an area of the market where a lot of people are doing potentially dangerous things without really understanding what they're doing. So I thought, by focusing on that, I can help a lot of people avoid the mistake of, using too much leverage or trading too frequently.
Okay. So today we'll touch at least some topics from all of these books. But before doing that, I'd like to go back for a while into your personal trading. You already mentioned some details. I wanted to ask you, is your trading fully automated? I mean, every strategy you're using, is it everything automated?
So as I said, I've got 3 parts to my portfolio. So the futures trading, which is one part, is completely fully automated. The stock trading is systematic but not automated. So what that means in practice is that I'm owning perhaps a dozen UK shares. I only trade UK shares in this part of my portfolio. And when they hit stop loss, it's automatically sold. And then the process of actually selecting and buying a replacement stock is something I have to do manually, although following a specific procedure. And then I have an ETF portfolio, which I rebalance every year. And again, that's a manual process, although it is systematic. So my trading, yes, is fully automated. Exactly.
Okay. And how much time do you dedicate to your own trading or own investments, let's say, per day?
Well, obviously it varies. And I'd say in actually running my futures trading system, it's probably less than 5 minutes.
Okay.
And in that 5 minutes, what I'm mainly doing is there are a series of automated emails that get sent by my computer system to me, and I'm basically checking that those emails are sort of saying that the system is running properly. So if I don't get an email, or if an email comes saying something's wrong, then I might need to go and look at something. The other thing I need to do on a regular basis is to roll my futures contracts. So right now, a lot of the futures contracts expire in mid-December, so I'm rolling those forward to January or the March normally expiry. That's something that could be automated, but I prefer to do that manually because the work involved is very small, and it's not worth spending time writing the code to do it properly and robustly. As in terms of my investing portfolio, so I spend a couple of days a year probably rebalancing my ETFs. That includes also, for example, when I'm rebalancing, I'm doing things like trying to, make best use of tax allowances. So I normally do that towards the end of the tax year. And I'm also, sort of rebalancing my cash between various places as well. So, it's partly trading I'd have to do anyway, and it's partly kind of sort of administrative activity I'd have to do anyway. And the stock portfolio, which is probably trading 3 or 4 times a year, and 3 or 4 times a year I'll have to spend maybe half an hour selecting the new stock, buying it, and then just updating my spreadsheet. So, add all that up, and it's probably still less than 10 minutes a day, I would say. However, I do spend then on top of that quite a lot of time writing code and researching to improve my trading system, which obviously, is separate from how it's actually running.
So you're still looking for better strategies, or you try to, adapt them to the market changes? So
it's a combination of things. So I kind of, I'm interested in markets from a sort of intellectual point of view. So there are things that I will spend time researching and investigating, which won't necessarily even go in my trading system because I'm just doing it as an intellectual exercise. But then there's the fact that the trading system, as I'm currently running it, the code's pretty old. It's over 5 years old now, and I'm in the process of replacing it with new code. And that code will enable me to implement some new ideas that I have. So it's definitely not, the one thing it's definitely not is adapting to the current market, because that's something I believe is a complete waste of time, and essentially is overfitting for the kinds of trading signals I'm running, which are quite slow. So it's sort of, it would be, changing my system partly to try out some kind of intellectual ideas I have that I think will make the system more profitable, but also more interesting, and partly kind of sort of code housekeeping, if you like.
Right. How about some holiday periods, let's say? For example, now we are just before Christmas. Are you still on the market during that period, or do you have any procedure how to be relaxed and to not think about markets, just to forget about it and just to really relax?
I mean, to be honest, I don't really think about markets very much at all. Like, I couldn't tell you what the level was of any stock market index, and the only reason I know where the for example pound dollar rate is because one of the headlines this morning was that the pound dollar rallied by I think 2% when the exit poll was announced last night with the election. So I spend very little time thinking about markets in a kind of direct looking at markets kind of way. I do spend a lot of time thinking intellectually about markets and how they move, and sort of strategies that would be profitable. So when I go on holiday, I do something that may shock people, which is I leave my system running, and it runs by itself, it trades by itself, and then I get back, and that could be 3 weeks later. So this summer I was away for 3 weeks with no access to the internet or anything, and sat down, and then I can see how the system has done. Now, to do that, you need to have spent a lot of time writing really robust code that will trade without any problems. You also need to have a lot of faith in your trading system, a lot of trust in what it's doing. So if you don't trust your system, then this is not recommended. You should definitely turn it off when you go on holiday. But the other thing you need to be doing is trading fairly slowly. So one reason I can be relaxed about leaving my system to run for 3 weeks without me being there is I actually tested and said, well, worst case scenario is that the day after I go on holiday, there's a power cut in my house, or there's a problem with the internet, or there's a problem with the broker, and I can't trade for 3 weeks. What effect would that have on my performance on average? And because I'm trading pretty slowly, it has a very small effect on my performance. We're talking about, the Sharpe ratio going from perhaps 1 to perhaps 0.98. So I know that on average, if I go away for 3 weeks, even if something goes wrong and my system can't trade, it's going to make almost no difference to my account value on average. In practice, it may go up a bit or down a bit, but on average, I'm pretty relaxed. And the other thing you need to have is a fairly modest risk target. So, my annualized risk target means that over a 3-week period, on average, I shouldn't make or lose too much money. So I can be relaxed that it's not going to have a big impact either way.
You put in your book a statement that non-professional traders should learn from the professionals and avoid 3 key errors: overconfidence, overbetting, and overtrading. Could you please explain?
So overconfidence is the fact that a lot of people really overestimate how good they will be at trading, or how good their systems will be at trading. And this is just kind of a natural human instinct. So behavioral economists have a name for this. They call it the Lake Wobegon effect, because apparently there's a fictional town in America where everyone thinks that they're above average. Now, that's fictional, but actually, if you ask people, for example, are you a better driver than average? Something like 90% of men, certainly, will say, yes, I'm better than average. Obviously, that's mathematically impossible. And if you ask a trader, are you better than average? You'll probably get a similar figure, maybe even higher, because I don't think a lot of people would bother trading if they didn't think they were better than average. Now, this is kind of harmless when you're driving a car, except when you maybe start taking risks. So you maybe start driving a bit too fast for the conditions, or driving when you've had a bit too much to drink, or doing some of the risky behavior. And then, you have an accident and maybe kill yourself and maybe kill other people. And there's an analogy here for trading, because there's no harm in being overconfident when you're trading, unless it causes you to do something crazy. And in systematic trading, the thing that you can do that's caused by overconfidence is overfitting your trading model. So basically, if you go into building a systematic trading model with very high expectations of what your profit should be, then your profiting process is going to be, biased towards trying to get that high performance that you think you should expect. And if you don't get it, then you're going to probably go down the route of overfitting the model until you get the performance that you think you should deserve, as you're such a great trader and such a great strategy developer. Overconfidence then also keys into those other two errors. So overbetting is essentially taking on too much leverage. And, if you think you're a brilliant trader, and if you've got a backtest where you've never lost more than 5%, you might think, well, I can increase my leverage by a factor of 5 because, then I'll never lose more than 25%. I could live with losing 25%. So I'll just, use lots more leverage and get much higher returns. And, that's pretty dangerous and stupid in the same way that they're driving a car too fast because you think that you're a good driver and you can handle it. It's pretty dangerous and stupid. And then the other thing that will happen if you're overconfident is that you will overtrade. You will put on too many trades. So you'll hold positions for very short periods of time because, you may say, well, okay, every time I trade, I have to pay a bit of commission. I have to pay a bit of a spread, but I'm such a good trader that I'll easily make that money back many times over. So, if I look at my trading and I'm trading once a week and making 10% a year, well, then maybe I should trade once a day and I could make, 5 times as much. And the truth is that whereas your trading costs are certain and known, your trading profits are very much an unknown. And you're taking a gamble by assuming that you'll make those extra profits and be able to cover those extra costs. So yeah, it's a sad fact that a lot of people think that they're much better traders than they really are. And even if you are a trader, there's an awful lot of luck involved. So you could be a good trader but unlucky. So you could be a very good driver, but if you're driving too fast, you might just be unlucky. You might, someone might step out in the road when you weren't expecting it to, and you'll have a nasty accident. So it's better to keep below the speed limit. It's better to trade conservatively. It's better to trade at a speed which reflects the level of costs you're likely to pay. And it's better to have realistic expectations of what the performance of a trading strategy will be, so you're not led down the path of overfitting.
Warren Buffett said once that a number of smart people are involved in running hedge funds, but to a great extent their efforts are self-neutralizing and their IQ will not overcome the costs they impose on investors. And the investors, on average and over time, will do better with a low-cost index fund. Would you agree with Warren Buffett with that statement?
I mean, it's really, really unfair of you to ask this question as someone who used to work in a hedge fund and has many friends who still do. So, how can I need to think of a diplomatic way of answering this question. I mean, one thing I could say straight away is that you could argue that Warren Buffett is actually running one of the world's largest hedge funds because, Berkshire Hathaway actually does use quite a bit of leverage. And although I don't think they do short selling, they do actually use derivatives occasionally. But anyway, let's move past that. I mean, a question to ask yourself is why do you invest in a hedge fund? What kind of returns are you expecting to get? And financial economists like to break down these returns into different buckets. So there's beta, so that's what you'd get from just investing in the market anyway. There's so-called alternative beta, which is what you could get from investing in a simple long-short leverage strategies, like a simple trend strategy, for example, or a simple carry strategy, or a simple equity value strategy. And then on top of that is alpha. So that's the skill. That's the high IQ that you're paying for when you hire the hedge fund guys. Now the fact is that the returns of hedge funds consist of all of these things, but you have to pay fees on the whole lot together. You can't pick and choose and say, I just want the alpha because that's the bit that is worth paying for. It's not worth paying for beta because I can just go and buy a low cost index fund. Definitely, it's not. Is it worth paying for alternative beta? Well, that's you shouldn't pay too much for it. But actually, many people can't necessarily go out and just buy alternative beta. It's actually quite difficult for the average person to put together a strategy which will actually extract these risk premia. So the average person might say, well, actually, I'm happy to invest in a hedge fund because maybe they're a beta neutral hedge fund, so I'm not going to pay for beta. They're giving me exposure to equity value, which I could get myself, but I can't be bothered with the mechanics of actually going out and buying some shares and leveraging up and then shorting some other shares. And then hopefully there'll be some alpha as well. Now, there has been a little bit of growth in ETFs that try and offer this alternative beta, but the fees on them are still quite expensive. So, they're still like maybe 1.5%, 2.5% management fee, which is a lot more than a low-cost index fund, but is probably less than a kind of proper hedge fund. So, yeah, it's a tricky one. I mean, for me personally, there's clearly no point in me investing in a hedge fund because I can kind of get this alternative beta myself, and it doesn't cost me anything. And there are small economies of scale involved with hedge funds, but yeah, I mean, I'd say on average, hedge fund investors are probably overpaying for not that much skill. But then, there can be an argument that it's still worth investing in them because you can get this extra source of return that you couldn't necessarily get otherwise.
Right. How about mutual funds? Do you think that because you were talking about mutual funds also in your Smart Portfolios book, is it reasonable to invest money through an active fund if it's delivering an average returns? I mean, if the fund is not beating the market, because now, at least technically, it seems to be very easy to be an average investor. I mean, just to buy an index fund. Do you think that it's reasonable to pay for being to just get an average result?
I mean, the argument I've just made applies even more so to mutual funds. So when you buy a mutual fund, you're essentially getting a lot of beta, which is something you can get through a low-cost index fund. You're also getting what is called smart beta, which is hence the title of my book. And that's, for example, being exposed to, cheaper stocks, for example, or to stocks that have momentum, or being exposed to, maybe different methods of portfolio construction. And then on top, you're hopefully getting alpha. But when you pay that mutual fund fee, the vast majority of returns you're getting will just be beta. There isn't really very much left over. And one of the things I try to do in Smart Portfolios is really say, what's a realistic extra return to expect from, a fund manager who's, running a value strategy? And then is it worth paying for if you don't think they have any skill, if you think they have average skill? And in the vast majority of cases, it's really not worth paying for active funds. I mean, I have no active funds in my portfolio at all. I just hold individual stocks. I hold futures and hold ETFs. Because I've never seen an active fund where the returns are kind of sufficiently high and sustainably high and sitting high enough that they overcome the extra drag on fees.
How about robo-advisors? Because you also mention this kind of investment in your Smart Portfolio book. Could you please maybe in the first place explain briefly the idea behind robo-advisor, and do you think that it makes sense to use such vehicle?
So, I mean, robo-advising is kind of one of these made-up terms, so it's not really a generally agreed definition of what it means. It's a marketing term, in the same way that smart beta and alternative beta are marketing terms. But most people are using it in this way. If you invest with a robo-advisor, what they will do is they will buy a portfolio of ETFs. So they will buy you, a portfolio containing maybe, a European stock market tracker, a US stock market tracker, an Asian stock market tracker, and then the same trackers for bonds. And maybe it'll be more granular than that, and they'll go into individual countries. And then what they will do is they will allocate your capital to that portfolio of ETFs according to your risk preference. So if you want more risk, they'll put more money into equities. If you want less risk, they'll put more money into bonds. And also they'll have some predictive model of returns. So they might think that stocks are going to do badly next year, so we're going to underweight stocks in this model. So the good news is that this is not a bad thing to do. Smart Portfolios essentially is a book that tells you how to do this. And this is how I run this third component of my portfolio. And the ETFs, the underlying ETFs themselves, are actually pretty cheap. They're investing in these low cost index funds. That's great. But on top of the low cost index charge, they make their own charge for the fees and the service that they're providing. And I don't really believe that the fees generally are worth it. So the fees sound quite low. I mean, maybe 0.5% or 1%, which doesn't sound very much. And then you do the low cost ETFs underneath, add only a little bit to that. But actually, for the value they're adding, it's really a very expensive way of getting someone to do something that actually is pretty simple for most people to do. And I also have some issues with the way that some of these robo-advisors actually manage their portfolios and the way that they allocate risk, which I believe is fundamentally flawed. And of course, you can't change that unless you do it yourself. You have to just take, they offer a few different funds for different risk targets, and you have to choose one of those. You don't have any choice about changing those parameters if you think that they're doing it incorrectly. So if robo-advice was almost free, so if they were charging, say, 0.05%, 5 basis points, I would say to a lot more people, robo-advice, find a good robo-advisor who's doing things properly, using the correct methodology, go for it. But unfortunately, unless your business has got huge scale, and I'm talking about, sort of Vanguard or BGI sort of size scale here, you're unlikely to be able to run a robo-advice business at that level of fee load because of the fixed costs of compliance and so on. So that's probably a pipe dream, sadly. At the moment, I mean, we've got free in the US now. There's commission-free trading, so maybe we're not too far off robo-advisors being pretty cheap and actually worth going for.
Right. You mentioned in your book that the most important factor to consider when trading and investing is risk. And you say that we don't have much control over our profitability, but it is quite easy, relatively easy to control risk. How would you define the risk and volatility? Are the synonyms, and how to measure risk, how to control it?
Risk is just uncertainty. It's if I invest in the stock market today, I know that there's a risk I will lose some money before the end of the year. Now, I kind of like to think of risk and split it into two buckets. What I would call the risk that is being measured by a model, and then the risk that's outside of that model. So, when we measure risk, we have to come up with some way of doing it. And then we know that method that we use is probably flawed and has some issues, but that probably something bad will happen, some so-called black swan that the model did not foresee. But actually, even by using a relatively simple risk model, which is to assume that, getting technical for a second, that all returns are Gaussian, which means that that they're symmetric and that unusually large returns are rare, which is a massive simplification because we just have to look at the stock market and we see many times that someone will be on the news and say, well, this was a 7 or a 8 standard deviation event. So clearly something that shouldn't really happen in this very simplified risk model view. But it's still, even with that very simple risk model, so, measuring risk by measuring the annual standard deviation of returns, which assumes symmetry, which assumes Gaussian returns. Even doing that, you can still predict risk, really well. So if you look at the returns over the last month, you can predict with a very high degree of accuracy how risky the returns of that asset will be over the next month, even if your risk model is really simple. So I personally, I mean, different people do this differently, but when I say volatility, I mean a specific measure of risk, which is standard deviation. When I say risk, I mean anything that could happen, so which both inside and outside the model.
All right. I'd like to talk a bit about trading styles. In your first book, you put a paragraph about that, and to take an occasion to explain more some details behind it. Let's say I'd like to talk about different flavors of trading or investing, for example. And the first, let's say, flavor you put in your book was static investing, static trading versus dynamic. Could you please briefly explain what is behind it?
This is the idea that what's the simplest thing you can do? The simplest thing you can do is just buy something and hold on to it forever. And that would be the most static portfolio that you could have. And a dynamic portfolio would be where you were trading that, continuously for various reasons. And there are that's, I guess, fairly well understood, but there are actually shades between that. So, for example, if you can hold a portfolio of an asset, but if you think that the risk of that asset is going to change, you may want to change the size of your position. You don't have any forecast about whether it's going to go up or down in price. It's just the risk that you're worried about. So you can go from having a portfolio that's static to having one that's a bit more dynamic, because it's just looking at the risk that's happening. So that's important, because when it comes to benchmarking your trading, a lot of people benchmark against a pure static portfolio. So they benchmark against the market index, and they say, well, I'm doing really well because I've done all this trading, and the market index has gone down. But a fairer comparison is perhaps to say, well, just targeting your risk, just changing your position for risk, can actually add quite a lot of value to your portfolio, but it doesn't require any skill. It's just a simple mechanical task. So what you should really do is benchmark yourself against a portfolio where that's happening. And I think that's a good move towards the idea of what I was saying earlier, which is, when you're distinguishing how much skill a manager has, or you have, your trading strategy has, you really want to strip out all the things that could be done very easily by somebody else, just to focus on the additional value that's being added by, your forecasting of what returns are going to be in this case.
How about positive versus negative skew? Because you mentioned in your book different types of strategies like trend following, and mean reversion. Or maybe in the first place, if you could briefly explain what the skew notion is and why we should care about it.
So skew is a fancy mathematical way of saying that your returns are not symmetric. So positive skew means that you are likely to have more losing days than winning days, but your winning days are going to be big. So you win big and lose small. And trend following is a classic example of this. So, if you look at, say, my own track record over the last 5 or 6 years, there's been a couple of years when I've made pretty decent profits, and I'm thankful to say that the last year has been one of them so far, touch wood. And then the other years were kind of small down or flat. And that's pretty much what you expect when you look at a trend following type of strategy. The opposite of positive skew is negative skew. And that's where you have more winning days than losing days, but an example of trading strategy like that would be an FX carry strategy, where you generally make steady profits, and then in a situation like 2008, you get absolutely carried out. If you're doing any kind of strategy where you're sort of biased towards selling options as well, you'll tend to make small profits every day and then lose big when the market moves a lot. If you're running a kind of market making or mean reversion type strategy where you expect to be buying, the market's in a range, you're buying low, selling high, you'll make small profits within that range, but when the market breaks out of that range, you'll make a big loss. Now, this is an important distinction to make, because it's really important to know what kind of trading you're doing. An analogy I like to say is, are you buying insurance or selling insurance? So if you're buying insurance, you've got a positive skew strategy, because if I'm currently paying an insurance premium on my house, a little bit of money every year, but if there's a fire or some kind of natural disaster, I'll get a big return, which will compensate me obviously for my house burning down. The insurance company has the opposite kind of risk profile. So, they make a little bit of money every year from these premiums that are being paid in. But then, of course, when a house does burn down, they'll have a big payout. Insurance companies can do this because, they've got a big diversified pool of people who are buying insurance off them. But I think a lot of people don't understand this distinction. And they'll often do things like run a negative skew trading strategy and think, well, this is great because I'm making money every day. This is brilliant. This is fantastic. I'm some kind of genius. And it'll work for a few weeks or a few months or even a few years. And then, a big tail event will happen and they will lose a lot of money. And that's not necessarily a problem if you understand that you're running a negative skew strategy and you've kind of got your risk set up such that you can survive that big loss. But, a lot of people don't realize that's, what they're doing. They underestimate the likely size of a big loss. And then when the market does change against them, they will lose a lot of money very quickly. So generally speaking, it's a lot easier to risk manage a positive skew trading strategy because you most of the time you're losing money. So you kind of have a good feel for what your likely losses are. And when those big gains come along, that's great. They go in the bank. But when you're running a negative skew strategy, it's a lot harder to know what your likely potential losses could be, and therefore you should be a lot more cautious with your use of leverage, for example.
But from the psychological point of view, probably the strategy which has a positive skew is harder to trade because people like to be right? And here we often have small losses, which people probably don't like, and they prefer probably a negative skew because, as you said, they think they are brilliant until they will get the first big loss. I really like the example you provided with that company, insurance company.
Yeah, this is a really fascinating debate because you're right. It's really, really hard to run a positive skew trading strategy. And one of the reasons why I think trend following works is that because it's positive skew, a lot of people are uncomfortable with as many small losses. You're absolutely right. But on the other hand, generally speaking, people do not like negative skew. So they prefer positive skew. So if you were to say to somebody, do you play the lottery? A lot of people say, yeah, I like to play the lottery. Even though on average you lose money, you're holding out for that big win. And that big win is a classic piece of positive skew. You've got small losses. Every time you pay the lottery, you spend a few euros on a ticket. There's that hope that you'll get a big prize and that big return. So that's very much a positive skew strategy, and people like that. So it's a very interesting kind of dichotomy in the way that people think. Because in theory, if you like playing the lottery, you should also like trend following. But in practice, because trend following isn't offering you, a chance of a 10 million euro payout on buying a €2 ticket, the psychology works a bit differently. So yeah, it's a very interesting thing to think about.
So do you think that trend following works because of the human biases? Because of the psychological biases?
Yes, I do. I mean, one advantage of not being an working for a university is I don't actually care why it works. I don't need to care why it works. I just have to hope that it continues working. My own kind of pet theory is definitely that it's around psychological biases. Absolutely.
But do you think that it's good then to put in the portfolio? We'll say about more about the portfolio construction later. But do you think that it's good to have in portfolio both flavors of the strategy? So, for example, we have a trend following, and then we are trading also mean reversion strategy, which is more having a negative skew.
Yeah, I mean, one of the key messages that I always go on about is that diversification is a good thing. So diversification across different trading styles is absolutely a good thing. I do have things in my portfolio that have negative skew, but I would say that if I was running a portfolio that was 90% negative skew, I'd be really concerned, and I probably wouldn't be able to go on a holiday relaxed, the way I can now. But I'm running maybe 20 to 25% negative skew, so that's kind of a nice diversification, but it's not yet at a level where it's started to scare me. So yeah, absolutely, diversify across different kinds of return, but you just have to be a lot more careful with that negative skew stuff.
How about technical versus fundamental analysis? I mean, I'm still talking about the trading styles, because, for example, technical analysis has a bad reputation, probably maybe due to a very naive way, which is used by how it's used by retail traders. So I wanted to ask you how about these different flavors between the technical and fundamental, and is technical analysis used by hedge funds as well?
Yeah. So again, this is one of those things there's no agreed definition on, but I guess technical analysis for me at least means using the price or some transformation or some function of the price series. Now, fundamental analysis to me then is everything else. So, for example, if you're trading stocks, you might use, earnings to price ratios or dividend yields. I've at times have looked at using macroeconomic data. So that would be, things like unemployment, inflation and interest rates. There's a whole variety of things you could use as well as prices. Now, you're right that technical analysis generally has a bad reputation. But actually, the vast majority of professional traders in hedge funds and elsewhere are using some technical analysis, and in some cases exclusively using technical analysis. And there's a few reasons why this is the case. And one is that it's actually a lot easier if you've just got one kind of data coming in. So for me, as someone who's now trading my own money without any help from anybody else, I just have to worry about the price of the things I'm trading. If I also had to worry about a lot of, accounting information and things like that, systematically collecting that data and making sure there were no mistakes in it, that's an awful lot of work to do. So, the fact that in my automated system I just use technical analysis is great. As it happens in my non-automated systems, I do use fundamental data because they're not purely automated. It's not generating any extra work for me. So that's why technical analysis is popular, I think. And there's nothing wrong with technical analysis. There's nothing wrong with using a price series to predict what will happen to prices in future. It's just that there are people doing it in kind of very wacky ways, and actually very much in non-systematic ways. So, there are guys staring at charts and saying, "Oh, look, I can see a leaping dragon or a dead baby or something like this," and that's clearly all. Oh, look, it's reaching a clear sort of key Fibonacci level. I mean, this is all nonsense. This is all complete nonsense. There's no evidence that any of this stuff works. It will only work in a self-reinforcing way. In other words, if enough people believe it, then it will work. But there's no reason why it should work. At best, these techniques are just finding trends, because you can use a number of different ways to find a trend. And actually, if I showed you a chart and said, "Is there a trend there?" you would say yes or no. That's just kind of simple pattern recognition. But you can do that with really simple technical indicators like moving average crossovers. And there's absolutely nothing wrong with that. It's just a systematic way of finding a trend. Because if you believe that markets trend, then your system will be profitable. How you find those trends is less important. So there's nothing wrong with technical analysis. There's equally nothing wrong with fundamental analysis. And actually, in terms of diversification, if I had a staff of 10 people working for me, I would be using fundamental and technical analysis because I would expect that to improve my returns, because I'm getting two different kinds of information that should improve my trading. The only reason I'm not, I said, is because it would be a lot of work and just for one person, and I'm pretty lazy.
How about trading speed? Because that's another big topic. And for example, retail traders, they quite often think that the right way to go is day trading. Do you think that trading less frequently is easier and gives more chances to be profitable in the long run?
I mean, the analogy I like to use is imagine that you've gone for a run, and you decided to run into a really stiff headwind, and it's really slowing you down. That's what day trading's like. That headwind is costs. It's additional costs that you definitely have to pay. So you're really going to have to be a really good runner to get a decent time and push through that headwind. If you trade more slowly, then the headwind will reduce until it's nothing more than a gentle breeze. So you're automatically making life much more difficult for yourself by trading more frequently, because you have to pay higher costs. Now, it might be, of course, that you do have a trading strategy that can do that, and there are strategies out there, and there are big hedge funds running those kinds of strategies. I'm not saying they don't exist, but for the vast majority of people, it's much easier and simple to say, well, I'm not going to try and compete with those guys. Apart from anything else, they're probably paying lower costs than me. They're paying lower commissions. Maybe they're a member of the exchange and they're not having to pay any kind of access fees. Maybe they're executing their trades in such a way they don't have to pay, the spread. It's crazy to try and compete with people like that by trading, in my opinion. Just make life easy for yourself and pay much lower costs. And then you're much more likely to find a strategy that can pay those costs and hopefully make profits on top.
Right, because I think that the common thinking of retail trader is that if he trades more often, he has more opportunities to make money. So trading less means less money. That's, I think, the common thinking.
Yeah. I mean, the other point I'd make is that markets behave differently at different sort of time horizons. So most markets seem to trend for holding periods of between a few weeks and about a year. If you go much faster than that, they tend to show more mean reverting behavior. Now, if you're a day trader and you're trying to sort of trend follow the market on a daily basis, you're doing something that's a bit stupid, because generally speaking, the most strong trending behavior is shown in much longer trading horizons than that. And the other thing is, because you're trend following, when you see a trend appearing, you're going to have to execute your order immediately at the market and, cross the spread. So you're going to be paying even higher trading costs than you would anyway. So, it's really difficult to make money day trading, I would say.
I'd like to talk a bit about systematic trading as such. And if someone would ask you to explain what systematic trading is all about, how would you answer?
I mean, it's trading systematically. So, it's using a system to trade. So, it's not always following a process that's written down that has very strict rules. So the definition I like to give is, if your process could be traded by a computer program, then it must be systematic. It doesn't have to be traded by a computer. You could use a spreadsheet or, a calculator to do the calculations, and then do the trading manually. But as long as you're absolutely following those rules strictly, then it's still systematic trading. So if you've got a trading process where, for example, you come up with a number of users, like a screen to come up with a number of possible trades, a systematic screen, that's great. If you then sort of have a gut instinct and choose the one you think will do the best, well, then you're no longer trading systematically. You're doing a kind of hybrid between the two. So pure systematic trading, a computer could do it with no human intervention because everything is written down with a completely complete algorithm. Anything that involves any discretion or human judgment isn't.
Because I've got an impression that at least some people are having they misunderstand the whole concept behind the systematic trading, and they more focus here on the automation of the process. I mean, automation of transmitting the orders on the market, rather than in the first place on having something reasonable to automate and to have a reliable strategy to control risk. And they think that you can maybe see this on the internet as well, that people are looking for an expert advisor. They just will plug it in and just will go on holiday and will have a lot of money made out of it. So I think that this is a big misunderstanding of that thing, that systematic trading doesn't have to mean that it's fully automated. I mean, that it's running on the computer. It doesn't have to be exactly that case. And in your book, Systematic Trading, you put three groups of traders or investors. The first one is asset allocating investor. Another one is semi-automatic trader, and the third one, staunch system trader. Could you please describe these types of systematic traders?
So the key difference between these three groups is their view on how predictable the markets are. So asset allocating investors believe that you cannot predict the returns in the market. They'd say you should just give up. So if you can't predict the returns in the market, what should you do? Well, the answer is you should have a diversified portfolio of assets that expose you to different things. So a classic portfolio we discussed earlier that a robo-investor might suggest of bonds and equity funds from different countries. But then it's taken a step further by saying, well, actually, as we've discussed, volatility is very predictable, and therefore it makes sense to actually adjust the allocation of that static portfolio according to changes in volatility. So the asset allocated investors, they can't predict returns, but I can predict volatility, and I can also predict correlation, which tells me how different market returns move together. So using that information, what's the best kind of portfolio I can hold? Well, it's a portfolio where you assume that all assets have the same risk-adjusted return, but where risk might change, and you can predict that, which means that you would reduce your allocation to assets where the risk has gone up, vice versa. And it also means you would try and hold a portfolio that diversifies you a lot. Semi-automatic traders have a different belief on how predictable markets are. They believe that they personally can predict market returns. They believe that computers cannot. They believe that a systematic strategy cannot do as good a job as they can at predicting where market returns are going to go. However, they are very comfortable with the idea that you should use a system for sizing your positions and managing your risk. So what they can do using the system I outline in my first book, and also in the final chapter of my third book, Leverage Trading, what they can do is come up with some quantified estimate for how they think different things will do. So they might say, on a score from -10 to 10, I'm -8 on the dollar, which means I'm really bearish on the dollar. I'm +2 on Euro stocks. I'm a little bit bullish on Euro stocks, and so on. And then they can use a simple algorithm which will essentially convert those forecasts into positions, which can then be managed by a system in terms of their size and their risk and stop losses, if relevant. So they kind of think that the skill of trading has two components. One only humans can do, which is predicting where markets will go. And then a second part that actually computers or a system can do much better, which is in terms of risk and position sizing. That's semi-automatic traders. So a staunch system trader is someone who firmly believes that a computer is best at managing risk, but also at actually taking the decision about where the market should go. So that's basically where I sit. I actually think, you should use a system to do everything, to predict where the market's going, to size your positions, and so on and so forth. So I use these three categories in the book to sort of say to people, look, well, you may not believe, like I do, that computers make the best traders. You don't have to believe that to use a system. In some, you can either use a system to do your asset allocation if you believe markets are unpredictable, or if you think that you've got some kind of gut instinct about how you trade, well, that's fine. I don't necessarily believe that I have that instinct, but you'll do much better as a trader if you do follow a system when it comes to managing the risk of your positions.
Right. So I think that to me very interesting was this semi-automatic trader, because apparently someone who's, let's say, discretionary trader, it seems that he still can be seen as a systematic trader, just following some framework to control the risk, to control the bet sizing. There's a very interesting story in your book, The Systematic Trading, describing a day from September 2008 when all markets were plunging, and at the time you were working for HAL, and people, as far as I remember, in the hedge fund were considering even closing some market positions because it was very high risk, and everyone was saying in the media what's happening. And at the same time, the system, the mechanical trading strategy made over $1 billion in a single day. Tell us a bit more about that. I mean, especially in the context of computers versus the humans and the decision-making process. Tell us, please, more about how it was to be in the middle of that gigantic financial crisis, I mean, in 2008, and how it looked from a perspective of a quant trader working for a huge hedge fund.
I mean, being in the middle of a financial crisis was pretty special. I mean, it was obviously, in many ways a horrific event, and a lot of damage done to people's jobs and livelihoods. But it was an incredible experience, and although it was very stressful at the time, it was something to say you were there. Now, I guess being in the middle of the financial industry, we kind of knew probably even a year and a half before that there were signs that things were going wrong. So although the equity markets, for example, kind of carried on going up, for all of 2017 and even the first part of 2018, there were other markets that we were monitoring, the credit markets, where things were getting very dicey, way back in sort of early 2017. So that the crisis didn't really kind of come as a surprise or as a shock, as it may have done to people in the outside world who weren't following things as closely. But every day seemed to bring a kind of, oh my God, is this really happening moment? It was just things that seemed almost completely unprecedented. And, the one thing I say to people in terms of trading a system is that you absolutely have to trust your system. You absolutely have to trust it. And one of the reasons why not many people trade systematically, that is the hardest thing in the world to do. Because, especially in a situation like that, you look around and you think, well, the world's gone completely mad. How can a computer system that's operating fairly simple trading rules that we know have worked for quite a long period of time because we've tested them and run with these? Actually, I mean, at the time, AHL had been running for over 20 years. How can we be sure that this thing can cope in this environment? And just so many crazy things happening. So it's a very strong human instinct to say, we can't we just have to do something about this. We can't let this computer carry on trading in this environment. It's too dangerous, especially as, the amounts of money involved are colossal, and it's other people's money. So, if something did go wrong, you'd feel a very strong sense of responsibility to all the people whose money you'd lost. So, it was only natural that we were kind of going, well, okay, the system's running a very high level of risk at the moment. It's managing its risk the way it should do. The system's doing everything it should do. There were no bugs in the code, and in fact, it was profitable. And as you say, on one day, extraordinarily profitable. So $1 billion, I put it in the book to sound like a lot of money. In percentage terms of the fund's value, it was about 6%, which may not sound very much, but for the kind of fund we were running, that was a record profit. We'd never seen a profit that size before. So, if we talk about David Harding, in fact, Winton made the decision at the time to cut their risk to lower levels because they didn't want to be in a situation where they could lose, a large proportion of their clients' money. We were having the same discussion and the same debate, and we were panicking and we weren't trusting our system. And we were, had very itchy fingers wanting to not turn it off completely, but at least reduce the risk it was running. And the system doesn't know about any of this; it just carries on trading and does its thing. And 2008 was a very profitable year.
But do you think that for a systematic trader, it's easier to go through such big crises rather than for discretionary trader?
Yes.
Or maybe the opposite.
Well, I guess it depends on your psychological makeup. So if you're a very good discretionary trader, and then you're probably a pretty cool customer, and you'll be able to cope with the ups and downs of the market, even perhaps the kind of things that are happening in 2008. But I think for the average person, if you can resist the temptation not to let the system keep running, and this is where automation actually is an advantage, because if you have to manually run your system, the temptation to not do certain trades, not to trade at all because the market's gone crazy, is extremely difficult to resist. If the system is just running, I could shut down my system in 5 minutes just by typing in a line of code. So it's not like it's impossible to shut down my system, but I have to make an active decision to do it. So I think for most people who don't have that really strong kind of psychological makeup, who can handle stress to that level, most people probably would be better off running a system with the caveat that they really do have to let it keep running by itself, which is easier if it's automated, definitely.
So if you don't trust yourself, it's maybe better indeed to have everything automated and shut down the computer. I mean, not to watch what the market is doing and just religiously follow the strategy, actually to do it, the computer to do its job.
Yeah, I mean, you have to trust the system, not yourself. Yeah.
Yeah. But do you think that, let's say that if you as a person, that you are prone to, to not follow the strategy, then do you think that indeed automating that process may be helpful if you don't trust yourself?
Absolutely. Definitely.
You mentioned in your books that there are two ways to find trading rules. The first approach is called data first, and the second one is called idea first. Could you please explain?
Yeah, so ultimately, the process of finding a trading strategy is you want to come up with, some rule with some parameters. So a simple rule might be something like, what is the return for the last n days, where n is a parameter, and if that's positive, then go long, and if it's negative, then go short. That'll be a very simple trading rule. So the question is, how do you come up with these rules? How do you fit the parameters? So the way that a lot of people imagine that you do it, and actually, I think especially with the availability of tools to do this now quite easily, even on a sort of standard desktop computer, is you have a big pool of data, and then you have some kind of algorithm that essentially looks at that data and then comes up with a trading rule that will perform well on that data. So something like a neural network, perhaps. The alternative approach is to not start with the data, but to say, right, I have a hypothesis that this particular trading rule will work. So I have a hypothesis that if the market trended for the last 2 weeks, it will keep trending. So you start with this hypothesis or this idea, and then you go to the data and you test it to see if it works. So, those are the two kinds of ways of doing things. So, as I said, data first is the way that a lot of people seem to think you should do things. Ideas first is, in my experience, usually a lot more successful, because the temptation with data first is that you will end up overfitting and finding a trading strategy that's really complicated, has a lot of parameters, and did very well in the past, but is unlikely to do well in the future.
So do you think that it's a bit problematic to use some fancy techniques like genetic programming algorithms or machine learning or other, let's say, artificial intelligence applications in general? Because I saw your review of Marcos Lopez de Prado book, Advances in Financial Machine Learning, where you said that, for example, I will just quote it, the more black box nature of machine learning also means that the sins of overfitting may be easily hidden from view. So I've got a feeling that you are a bit skeptical about applications of artificial intelligence. And also I heard on the other side a different view that the genetic algorithms, for example, where as an input we have historical data, and someone was claiming that it may be a good idea because algorithm doesn't have a human biases, so it may come up with, let's say, a non-standard idea which we as a human beings wouldn't think of.
I would say that my main bias against these fancy techniques is it's very easy to use them badly and to overfit them essentially. So a lot of the people who are using them do not know what they are doing, and that's why Marcus's book is so good, because it tells you how to do things properly. But I've heard people say to me, "Oh, well, I wanted to use machine learning." I say, "Well, buy Marcus's book," and they come back and say, "Well, I can't understand it. It's too difficult." I'm like, "Well, in that case, you should not be doing machine learning." But they're like, "Well, all I need to do is put the data into this software program I've downloaded off the internet, and it will give me the answer. I don't need to read Marcus's book." I'm like, "You really should not be doing this, because and this is a problem." So there's nothing wrong with machine learning per se, and I can give you a few different situations in which it's actually a good thing, I would say. But you really need to know what you're doing. So where are the places of machine learning might make sense? So it makes a lot of sense, I think, if you're sort of more of a high frequency trader. So I know a lot of hedge funds, quant hedge funds, who are not using machine learning in their main kind of strategy of sort of predicting where markets are going to go, but what they are doing is their execution algorithms, which are working at a much higher frequency. With those, they are using machine learning. Because they're higher frequency, there's a lot more data available. So it's a lot more likely that they'll be able to find something meaningful there. So that's the first instance. I know of some banks using machine learning to do kind of sort of things that are a bit left field and a bit more interesting. So an example would be, let's say that you had a lot of kind of accounting ratios, and you wanted to think of a way of saying, well, which accounting ratios are important in terms of selecting which stocks should do well. Now that kind of stuff is quite hard to do with sort of your standard classical econometric techniques. So things like, essentially this is a clustering problem. There are the machine learning techniques that do that really well, and will do a better job of it than say running a regression, which is the way that people usually kind of cope with this problem. So that's an example where a judicious use of machine learning can give you a good sensible result. And I'm trying to think. Yeah, I mean, actually, coming back to what you said yourself, it's possible that machine learning is another one of these very ill-defined terms. But let's say a non-linear fitting technique will find a pattern that a linear fitting technique will not, or a human being wouldn't see or expect, or prime the fitting model to find. And I think that's more likely in the high frequency world. It's more likely, when the data is very non-linear. So there are those things out there, but I'd say the vast majority of people who are trading, using machine learning is at best complete overkill, and at worst will just lead them down a rabbit hole of overfitting their models without really understanding what they're doing.
But do you think that in general, I know it's simplification, but do you think that for artificial intelligence as such, because I also was studying computer science, so basically sometimes we see marketing words that say that this is a so brilliant new technology, but actually the theory behind that is pretty old. It sometimes has decades. And do you think that still for artificial intelligence there is a future in terms of in the investment world, so to speak?
I mean, of course, there's a future for it. I mean, part of the problem is it's hard to define what all of these terms mean. So people say, "Oh, do you use machine learning?" I'm like, no. I say, but yeah, I do regressions, and I do this, that, and the other. I do these sort of classical statistical techniques, and they're like, "Oh, well, that's machine learning." I'm like, "Well, if you say so." So, I mean, artificial intelligence perhaps is a bit more of a kind of well-defined term. I mean, I think there's a future in it, but I don't think that it will be the case that you will not, let's say in 10 or 20 years' time, if you say something like, oh, in 20 years' time, you won't be able to trade it without knowing how to use artificial intelligence. I fundamentally disagree with that. I think you'll be able to do a good job of fitting the vast majority of systematic trading strategies using techniques that are actually over 100 years old. So, I'm not saying it won't be important, and I'm not saying there aren't areas where now actually it will give you an edge. But, generally speaking, that's still going to be quite a small part of the market, even going forward.
So do you think that there's, in fact, a limited number of rules which work on the market? So that's why maybe this approach, idea first, maybe it's more reasonable, especially for someone who's not a big fund and is just like, a single person just trading its own money. So it's better to focus on this idea first approach and use in own trading the things which are really proven. And it's known that it's been working for even centuries.
I mean, that's my personal view. I mean, the problem is that everyone has this dream that they will somehow be able to find this undiscovered trading rule that no one else has ever found, because they've even though they've got the same machine learning package and the same data that everybody else has got, but they'll find this rule that no one else has found, and they'll be able to make ridiculously high profits from it. I just think for almost everybody in the world, apart with the exception of a very small number of hedge funds, I mean, we could talk about Renaissance, we could talk about DE Shaw, but for the vast majority of people, that is not likely to happen.
You put a nice story in your book about the Aqueduct Capital, a local proprietary trading firm. And you were just describing that as an example of perils of fitting, how it can go really wrongly. Would you have a problem to trade a system which is hard to explain, although maybe it has outstanding results in the backtest? That was just the case from your story about the Aqueduct Capital from your book.
Yeah, I mean, I would personally struggle to trade a system which I couldn't explain, definitely. And that's the problem with these fancier techniques. Something can come out the other end. You don't really understand what it's doing or why it's making money. And that's I wouldn't personally trust that with my money, and I certainly wouldn't trust it with somebody else's money, if I was still trading other people's money.
How much data is needed for system testing? Is there any, let's say, minimal number of transactions to trust the system that we know that indeed it may be something in it and we can try to run it with real money?
A lot more than you think. So there's actually a mathematical equation you can use to calculate this, but basically there's two factors that go into it. One is what the kind of real performance of the strategy is, and how, and if your strategy is really, really good. So, most likely, if you're running, say, a high frequency trading firm, you can probably get away with using a month or a couple of months worth of data, because that 2 months will be actually, millions of transactions probably, anyway. And it's because it's very profitable. That also means there's the kind of signal to noise ratio is going to be very high. But if you're dealing in the kind of world where I am, where I'm trading much more slowly, and also where the performance of any individual component of my trading strategy is probably just about barely distinguishable from noise, you do need to have, a lot of data, and I would say ideally decades worth of data. And that means, for example, that you also want to be fitting across lots of different instruments at the same time, so that increases the amount of data that you're using. So that makes it hard, for example, to do something that a lot of people think you should do, which is generally a mistake, which is to trade all of your instruments a bit differently and to fit them individually and have different parameters for each of them. Generally speaking, that's a bad idea, and what you should be doing is using all the data you have to fit a single model that you can apply to everything.
We could talk a couple of days, but just shortly, if you could explain what is portfolio optimization, and how could you also explain what bootstrapping is, how it helps in portfolio optimization?
So portfolio optimization is just a way of saying how much of my money is going to be allocated to different things. And those things could be, you could have a portfolio of stocks. So you could say, I want to buy, all the stocks in the Euro Stoxx 50. But what should I put? 2% in each stock, or a little bit less, or a little bit more. It could be a portfolio of ETFs, which we've also talked about, or it could actually be a portfolio of trading strategies. So you could have a trading strategy for gold, a trading strategy for S&P 500, a trading strategy for Euro Stoxx, and so on and so forth. And then you need to decide how much money you put into each of those. So what kinds of things should you consider when you're doing that? Well, you need to consider the risk that they have. So, we need to put less money into things that are riskier. When we're doing that with trading strategies, we don't have to worry about that, because trading strategies, when built properly, should all have the same long-run expected risk. We also need to worry about correlation, so how similar these things are. So, we really want to put together portfolios that are diversified and have the maximum amount of diversification within them. So, that means adding strategies that do something a bit different from what you've already got. Like, for example, as we've said, adding a little bit of negative skew to a positive skew suite of strategies. And the other thing you may want to consider is how the expected return of these things, the expected risk-adjusted return. So you want to put more money into things that you expect to do better than others. That's quite difficult, because generally speaking, it's much harder to predict risk-adjusted returns than it is to predict risk or correlation. So one of the tricks is to try and use a technique that will properly account for the uncertainty involved with estimating these things that tell you what kind of portfolio you should have. And bootstrapping is one of those techniques. And what you do with bootstrapping is you basically say that what I'm going to do is I'm going to come up with a number of different scenarios as to how my backtest could have turned out by randomly choosing dates from the past and putting those together to create new account curves. And then I'm going to optimize my portfolio for each of these. So I might do this 10,000 times. I've got 10,000 different versions of history in which the backtest turned out slightly differently. And in some cases, I'd put more money into gold and less into Euro Stoxx and vice versa. And then to actually work out what weights I should be using, I take an average across all of those alternative histories, if you like. This is a really quite simple and relatively robust way to ensure that your portfolio optimization is taking account of the fact that you've got a lot of uncertainty in your estimates, and it makes it much less likely that your optimization will come out with very extreme portfolio weights. So, the kind of standard portfolio optimization tools will tend to do crazy things like put all the money into one asset or one trading strategy because it only has a slightly higher return than the others, and they think, well, it's got a slightly higher return, let's put everything in that. That doesn't account for the fact that slightly higher return is probably not statistically significant. If you do bootstrapping, then it will put a little bit more money into that strategy, a little bit less into the others, but it won't go, 100%.
Right. Thank you, Rob, for that. I have a couple of various questions, let's say. What tools do you use for your personal trading? Here, the programming languages or software packages or maybe brokers, if you want to say that publicly, which one you use?
Yeah, I use Python. I've written my own software in Python that does all my automated trading. For my non-automated trading, I'm literally just using a spreadsheet. I could put that in Python as well, but it's a lot of work for no return because a spreadsheet does just as well. The broker I use, I don't mind saying because I've said it plenty of times before. It's called Interactive Brokers. They're not the best broker in the world. They're not the worst broker in the world. There are a few reasons why I use them. For my automated trading, at least. One is that they offer an API, which is a way of connecting with them so you can do the trading with the code you've written yourself. So that's absolutely essential for me. The second thing is they have quite a wide range of markets that you can trade all across the world. So, there's probably hundreds of futures markets I could trade with them if I wanted to. And the third reason is their costs. They're pretty cheap. They're charging quite a low rate of commissions, which obviously is a good thing. I use other brokers as well for different parts of my portfolio. So I use about 4 or 5 brokers in all. Because some are better for different kinds of some are better for stocks, some are better for a particular kind of tax sheltered account we have in the UK called ISA or pension. So yeah, it's I wouldn't say that they're the best broker. They're pretty good, and there's various reasons why it makes sense for me to use them at least.
I've got a question from my listener about high frequency trading. So you said that data first approach may be applicable here in high frequency trading because we have lots of data. But do you think that high frequency trading will be, or maybe it's already more difficult due to some regulations? And another question, is there a future for such trading approach? I mean, should an average investor be afraid of high frequency trading?
I mean, the thing about high frequency trading is it is a legitimate thing to do. I think a lot of people think that it's all bad. But if you essentially, these people are offering the same service that traditional market makers used to offer, which is that if you're going to do some trading and you want to sell and there's no one there that wants to buy at exactly the same time as you, then they sort of step in and hold that risk for a short period of time. And with high frequency trading, that time period can be very small indeed. And that is a worthwhile thing to do. And it's a negative skew strategy, as we mentioned before. So they will make lots of small profits and probably occasional big losses. The question becomes, firstly, how much should that service cost? So, how much money are high frequency traders sort of taking out of the market for the service they're providing? And the second thing is, are there elements of what high frequency traders are doing or were doing that you can say actually that is, it's not necessary to do that, and that looks like kind of quote unquote cheating. So things like kind of front running across exchanges, or using like very strange kinds of orders that exchanges designed deliberately to favour high frequency traders. That starts to feel a little bit like I know, is this really the right thing to do? I mean, essentially, if high frequency traders stopped making money, then there would be nobody in the market making the market. So it would cost more to trade. Spreads would increase. If high frequency traders are making too much money, then spreads would be narrow, but actually overall there would be a reduction in the returns that the rest of the market was making. What the right level for that is a difficult one, and partly kind of normal economic competition to a degree helps here, in the sense that if high frequency trading gets too profitable, you'll get a lot of people going into it and bringing the returns down. When that doesn't happen, then yeah, regulation may be necessary. So I mean, I think some kind of version of high frequency trading will always be with us, because ultimately there has to be somebody in the market willing to buy when you want to sell and no one else is around. I think the key issues are, how big a part of the market should that be? How profitable should it be? And how much it should be regulated. But I don't think it's ever going to go away.
I've got some final questions. If someone would like to start investing her money, what would you suggest to such person? I mean, because most probably people are starting with discretionary approach, trading or investing. Do you think it's wrong, or maybe it's not that wrong and it's good to make the whole path?
I mean, it partly depends on why they're doing it. So if they want to just have money invested so that in 20, 30 years' time, they can open up their account statement and hopefully have enough to retire on, then I would advise just doing something very boring, which is just investing doing what Warren Buffett said. Go and buy a bunch of low-cost index trackers, reasonably diversified portfolio, and you could even then just not do any trading and just sit on them, and you'll probably do pretty well. If they want to learn about trading and investing, then I would suggest maybe doing that, but then also having some money which they then use to say, okay, I'm going to buy a stock. I'm going to watch that stock move around, and if they find that's kind of interesting, and then maybe they do want to think about the sort of thing I talk about in leverage trading, which is we're actually saying, right, I'm going to use a system to trade. Simple system, it'll trade a few times a year. just try it. Start dipping your toe into the water. It will tell you, A, if it's something you do find interesting, and B, it'll mean that if you make mistakes, that it'll limit the damage you can do to your trading capital. And you think, yeah, actually this isn't for me, and you want to go back down the low cost index investing route, or you may get into it, in which case you at least you'll know the basics and be able to avoid doing anything too stupid like overtrading or being over-leveraged.
And do you think that quantitative approach to trading and investing is easier or more difficult than, let's say, 10 years ago, or when you were starting your career back in 2002, if I'm correct?
It's definitely easier to access because, there are broker APIs, as we've discussed. There's lots of, programs that you can buy or even use for free that will allow you to run trading systems. There's a lot of open source code you can pick up. There's a lot more books and things out there. It's generally speaking, it's cheaper to trade. Of course, the downside of that is that like all of these things, if there was any easy money to be made, that's gone. It's now, you could do fairly simple things 20 years ago, and now those simple things, a lot of people are doing them. You can still make kind of reasonable returns, but it's not going to be, you're not going to make a lot of money. But that's just the cycle of the way markets work. I mean, I think if I tried to do what I do now 20 years ago, I would really have struggled because it would have been a lot more difficult. So I'd say from that perspective, it's definitely got easier.
Have you read the latest book about Jim Simons, the man who solved the market?
I have. Well, it's a great book.
And any comments?
You shouldn't read it if you think, if I read this book, that I'll work out how Jim Simons makes all his money. You will learn almost nothing in that respect. It's a great story. And one of the most striking things to me is reading through it. There's about 4 or 5 times where Jim Simons actually sort of talks in the kind of terms we were discussing earlier. And he's like, oh, goodness, I don't trust this trading system. I think we should override it and do this instead. Or he's talking about his own personal portfolio and he's having a discussion with the broker about whether he should buy or sell. And he's like, oh, I'll just go with my gut. I mean, this is a guy who's, made more money from systematic trading than anyone else, I would say. So what I found most interesting about that book was the fact that Jim Simons, has the same flaws as I do and as anyone who's trading systematically does, which is, much as you want to trust your system and let it run, you're still going to have these doubts about whether that's the right thing to do. So, I found that the most illuminating thing about the book, definitely. But yeah, no, great book and definitely worth reading. Just don't expect to find the Holy Grail in there because it's not.
All right. Any other books you would recommend to read apart from yours, of course, which I do really recommend, and really I'm very grateful for these books because they show this investment world from a different perspective, from the perspective of someone who is professional. So for someone like me, a retail trader, that's a novelty.
I mean, so many books. Where to start? I guess I'll just try and pick out a few at random. So in terms of the mechanics of trading, and also in terms of he writes. He's got a series of books he's written where he's interviewing traders. Books by Jack Schwager, I would recommend those. I would also recommend books by Andreas Clenow. So he's written a couple of books on trend following, one in futures, one in stocks. So, and they're a bit easier to read than my books. I think you'd say mine are a little bit more academic or technical in nature. His are a bit easier to read. So maybe more, if you're finding my books heavy going, then maybe have a look at his. And he's also written a book recently about how to use Python programming language, which is what I use to build and backtest trading strategies. And I'm slightly biased because I actually wrote a guest chapter in that book. So, I obviously think that's a good book. Yeah, I mean, one thing, I guess you put the link to my website and my blog, and that there's actually a page on there where I list about 30 or 40 books that I've kind of read and found interesting because I read pretty widely, and it's very hard to sort of even pick one book and say, yeah, this is the book you have to read. Even my books, I'd say you have to read more than one book to learn how to trade or learn how to code.
And how about other sources? I don't know, blogs, podcasts. Do you have any favorite ones?
So for blogs, I mean, there's a website called Quantocracy.
Right.
So it's the word quant followed by the word ocracy as in aristocracy. And that's really good because what they do is they actually have a curated list of links to different blogs, and that's updated every day whenever any of these people publish. So again, I'm probably biased because I'm on there as well. But if any blog that links to from that site is normally definitely worth reading, I would say. And there's a good range of articles there, from perhaps more technical stuff like the kind of thing I put on my blog to kind of more basic stuff as well. So rather than recommending a single blog, I'd say if you go to that site, you'll get links to a bunch of other blogs that are really interesting.
By the way, Andreas Kleno was the guy who recommended me to make an interview with you, because he said that you're just wonderful guy to make an interview with. So that's why we are here.
Yeah, he's always doing that, which is nice, but also a shame, because then every time I meet him, I'm like, I suppose I owe you another beer for that recommendation, and it adds up to a lot of beer.
Okay. Is there anything else you would like to add? Maybe a question I haven't asked you. Is there anything else you would like to say before we will finish this interview?
No, I mean, just I think generally to say to people that we've kind of touched on a lot of negative things about trading and investing, but it's absolutely fascinating and interesting world, and don't be afraid to get into it if you do find it interests you. Just be aware that there are a few pitfalls you need to be careful about, and hopefully I kind of pointed you in the direction of avoiding some mistakes, so you'll have some money left at the end.
Okay, thank you very much, Rob, for your time today. You shared with us a lot of great knowledge, so thanks a lot and all the best.
Thank you.
Thank you. Bye-bye. Take care.